Hello and welcome to this video. So in this video, we're covering question 1 of TAT letter 108 of 2022 for FAC 3761. So the structure of this video, I'm going to read through the scenario, highlight some important points, and then answer the required in Google Sheets. Okay, so let's jump straight into it. So it says, Ngu-X Ltd is a company that produces mathematical digital video discs for high school students. The company has a 31 March year end. The following information relates to the assets of the company. So it's important to take note that our financial year end is 31 March. So that means a financial year runs from 1 April to 31 March. So just keep that in mind. So Property Johannesburg, on 1 October 2008, the company purchased a manufacturing property for 8 million Rand. Land is 2.3 million and buildings is 5.7 million. The residual value of the building on acquisition date was estimated to be 5 million Rand. The property was available for use as intended by management on the acquisition date. The building is expected to have a useful life of 20 years. Both residual value and useful life of the building remained unchanged throughout the period. Okay, so what's important over here, we can see we have a property. The property is split into two parts, land and buildings. Okay, so that's important. From an accounting perspective, land is not depreciated, whereas buildings is. Okay, they're telling us that the property was available for use on the date of acquisition. That means it is from that date that we can start depreciating. So remember, when it comes to PPE, we start depreciating from the date it was ready or available for use. There could be 3 dates. Date number 1, the date the asset was purchased. Date number 2, the date the asset is available or ready for use. And date number 3, it is a date that the item, the asset, is actually used. So when we depreciate when the item is ready or available for use. Okay, so that's very important. They say the land was revalued for the first time on 31 March 2011. On this date, the fair value of the land was determined to be 2.4 million Rand. Okay, so there you can see 31 March is the end of a financial year. We don't know which financial year it is, and that the fair value was 2.4 million. So you can see there must have been a revaluation gain of 100,000 Rand. The cost price of the land, 2.3, it has been revalued to 2.4, so that means there must have been 100,000 revaluation gain. On 1 February 2012, the directors of the company decided to sell the Johannesburg property and to relocate the manufacturing operations to Port Elizabeth. A binding sale agreement was concluded on 1 February 2012, and the Johannesburg property was sold for 5.8 million Rand. Okay, so that is in 2012. Okay, next property. Property Port Elizabeth. As a result of the decision to relocate its manufacturing property to Port Elizabeth, Ngu-X Ltd acquired a manufacturing property in Port Elizabeth on 1 February 2012 for 9 million Rand. Land is 2 million and building is 7 million. The property was available for use as intended by management, as well as brought into use on acquisition date. On acquisition date, the residual value of the building was estimated to be 4.5 million. The estimated useful life of the building was determined to be 25 years. Both the residual value and useful life of the building remain unchanged throughout the period. No revaluation of this property was performed in the current financial year, as the property will only be revalued every 2 years. So you can see they purchased it on 1 February 2012 and they call it the current year. So I'm assuming the current year is the current year ends 31 March 2012. So we have a financial year running from 1 April 2011 to 31 March 2012. DVD recording machine. The directors decided to sell the company's existing DVD recording machine because the relocation cost to move the existing machinery to Port Elizabeth were too expensive. All the requirements for classification of the asset as held for sale were met on 30th November 2011. A binding sales agreement regarding the machine was concluded on this date, and management expects the cash sale to be completed on 10 April 2012. So you can see 10 April 2012 is after the current financial year. The recording machine was originally acquired on 1 March 2009 for 1.8 million and was available for use as intended by management, as well as brought into use on the acquisition date. On acquisition date, the useful life of the machine was determined to be 700,000 units and the residual value 300,000 Rand. From acquisition date until 31 March 2011, the machine produced 65,000 units. During the current financial year until 30th November 2011, the machine had produced 80,000 units. The machine's fair value less cost to sell on 30th November 2011 was determined to be 1.5 million and remained unchanged on 31 March 2012. Additional information: the following accounting policies applied to the assets of Ngu-X Ltd. Owner-occupied land is accounted for using the revaluation model. It is the policy of the company to realize any revaluation surplus upon disposal of the underlying asset. It is company policy that the revaluations will be made with sufficient regularity to ensure that the carrying amount do not differ materially from which would be determined using fair values at the end of the reporting period. Owner-occupied buildings are accounted for using the cost model. Machinery is accounted for using the cost model. Depreciation on buildings is provided for according to the straight line method over the estimated useful lives of the buildings. Depreciation on machinery is provided for according to the units of production method. The fair value of the land was determined by Prof. Charak, an independent sworn appraiser who holds a recognized and relevant professional qualification. Prof. Charak has recent experience in the location and category of the properties being valued. The fair values were determined with reference to the current market price on an arm's length basis for similar properties in the same area. The South African Revenue Service allows for the following capital allowances: an annual building allowance of 5% on the manufacturing building according to Section 13(1) of the Income Tax Act on a straight line method not apportioned for part of the year. A tax allowance on the machinery over 6 years according to Section 11(e) of the Income Tax Act on the straight line method apportioned for part of the year. The SA normal tax rate is 28%. The capital gains tax inclusion rate is 80%. Deferred tax is provided for on all temporary differences using the statement of financial position approach. There are no other items causing temporary or exempt differences except those identified in the question. The company will have sufficient profit in future against which any unused tax losses can be utilized. Assume all amounts are material. Okay, so the scenario is not that complex. The required is as follows. So, this is the required. Prepare, number one, prepare only the following notes to the annual financial statements of Ngu-X Ltd for the year ended 31 March 2012. Okay, property, plant, and equipment. A total column is not required, and non-current assets held for sale. Your answer must comply with the requirements of IFRS. Accounting policy notes are not required. Show all calculations. Round all calculations to the nearest rand. Ignore comparative information. Ignore any VAT implications. Okay, so I'm going to do 1.1. I'm going to do number 1.1 and 1.2, and then we'll go on to question 2. So let me switch over into Google Sheets. Okay, so you should be able to see Google Sheets. So we need to do question 1. Okay, so question 1, we're going to do property, plant, and equipment. So we need to prepare the note. So remember, it's going to be company name in Ngu-X Ltd. The next one is going to be the statement name. So it is notes to the annual financial statements. So notes of the annual financial statement. Annual financial statements for the year ended. Okay, so it's number 1, company name. Number 2, the statement name. So notes of the annual financial statements for the year ended. And then number 3, you put in the date, 31 March 2012. Okay, so that is our what we need. So it's always 3 things: company name, statement name, and date. Okay, then we're going to do, we want the property, plant, and equipment. So this is going to be property, plant, and equipment. Okay, so that's that note. So how does it look? We're going to list the assets in columns. So the assets that they have is land, it is building. So remember, from an IFRS interview, land and building is separated. And then we have machinery. Okay, we're not required to have a total column, but I will just put in a total column. Okay, so we will start off with cost, then it will be accumulated depreciation. Okay, so then we have accumulated depreciation, and that will give us carrying amount. Okay, so costs less accumulated depreciation gives us carrying amount. Carrying amount at 1 April 2011, the beginning of the financial year. Okay. So there we go. Okay, then we need this. Let's do this. Okay, so then we need this for the end of the period as well. Say Control C, Control V. Okay, so we're gonna have cost, accumulated depreciation. Cost less accumulated depreciation gives you carrying amount. Carrying amount when? 1st April 2011. So we want the same thing, but this time for the end of the year, which is 31 March 2012. Okay, so now what we'll have to do, we must explain how did the opening balance move from the opening balance to the closing balance. And the things that will cause the movement is additions, if we purchased any new assets, disposals, if we dispose of any assets, depreciation during the year, revaluation during the year, impairment. Okay, so these are the typical ones. These are the typical ones. So additions, disposal, depreciation, revaluation, and impairment loss. Then in our case, we have another line item called transfer to a non-current assets held for sale. I'm using the shorthand. You'll have to write the full. You'll have to write the full word term out. Non-current assets held for sale. Okay, so that's basically what will come through over here. So now let us start. So let us start now. Okay. Okay, so I'm going to start with land. Okay, so remember the opening balance is 1 April 2011, which is the same as 31 March 2011, which is last year's closing balance. So in the current year, so we would need to have the current year. So all I'm going to do is I'm going to go line by line. Or item by item, asset by asset. Okay, so I'll do this one first, answer everything, then move on to the next. Okay, so we know on 1 October 2008, the company purchased a manufacturing property for 8 million. 2.3 was the land and 7.5.7 was the building. Okay, so that should have been the cost price. So if I go, so land would be 2.3123, buildings would be 5.7. 1, 2, 3. Okay, just an important point to take note. I'm going to change this just now. I just want you to work through the thinking with me. Remember, these are the cost prices. Okay, but when it comes to land, only land is at a revalued amount. So we need to have a look whether at this date land was already revalued or not. If land was not yet revalued by 1 April 2011, then we will use the cost price. But if land was revalued by 1 April 2011, then we need to use the revalued amount. Now, if you remember the scenario, we'll go through it now again. But if you remember some scenario, they told us land was revalued for the very first time on 31 March 2011. 31 March was the day before this date. So therefore, we can't put in the cost price. We need to put in the revalued amount. Okay, so it's 2.4. So just take note of that. Only land is for our purposes, only land uses the revaluation model. So just always take note when it comes to the cost price, you want to put in the cost price. But for land, you need to ask yourself, was land revalued by this date we are looking at? The date we are looking at is 1 April 2011. So if land was revalued by that date, you have to use the latest revalued amount. So in this case, land was revalued the day before 1 April 2011 on 31 March 2011, which was the end of the previous financial year. And the revalued amount was 2.4. So therefore, we use the revalued carrying amount. Okay, so you can do it like that. Cost. Okay. You can check the proper terminology. I think it's called the revalued carrying amount. Okay, so that's what we will do. Okay, so let's go back to the scenario. Okay, so we covered that part. They said the residual value of the building on acquisition, it was estimated to be 5 million. The property was available for use on the acquisition date, which is 1 October 2008. So therefore, what we can do, we can start depreciating from 1 October 2008. Both the residual value and useful lives have remained unchanged. Okay, so if we go back to if we go back over here, we want accumulated depreciation as at 31 March 2011 or 1 April 2011. This is land, there will never be depreciation. Okay, now we need to work out accumulated depreciation for buildings. So I will do the workings over here. Okay. Okay. So working one. So I want to work out accumulated depreciation as at 1 April 2011. So I'll work out depreciation. Okay, so we're using the straight line method. So the straight line method says cost price. So straight line method says cost price less residual value. That will give me depreciable amount. Take the depreciable amount and we divide it by the useful life. Okay, so cost price minus the residual value gives me depreciable amount. Depreciable amount divided by useful life gives me annual depreciation. Okay, so this will give me annual depreciation. Okay, so that gives me annual depreciation. Then I can say number of months used in the year, and that will give me current year depreciation. That's basically like a standard format I set up to calculate depreciation for the current year. Okay, so depreciation for the current year. Okay, so when it comes to the building is 5.7 million. 1, 2, 3. We have a residual value of 5 million and it hasn't changed. Okay. Okay, and then so cost minus residual value gives me depreciable amount. Depreciable amount divided by useful life for property Joburg is 20 years. So the depreciable amount divided by useful life gives me an annual depreciation of 35,000 Rand. Now I'm in the current financial year, which is 1 April 2011 to 31 March 2012. Now remember, they told us on 1 February 2012, there was a change. Okay, so on 1 February 2012, so 1 April 2011 to 1 February 2012 is 10 months. Because what you will know, the financial year end is 31 March. So that means we never used it in April. We never use it in February and March. We never use it for 2 months out of the full year. The full year is 12 months. We never use it for 2 months. So that means 12 minus 2 give us the number of months we have used it for in the year. Another way to do it is to calculate the number of months from 1 April 2011 to 1 February 2012, which will give you 10 months. So then I'll say depreciation using the current year, it is 35,000 divided by 12 months times the number of months used, and there we go. Okay, so depreciation in the current year is 29,167. Okay. Next, now I want to work out accumulated depreciation. Okay, so now I want to work out accumulated depreciation. So accumulated depreciation, so I will have October 1 October 08 to 31 March 09. Okay, then I'll have 1 April 09 to 31 March 2011. Okay, so this year is 6 months. Okay, and this year is 2 years. Okay, so 2 years is 2, 6 months is 0.5. Okay, so total number. Okay, total number of years up to end of prior year. Okay, will give you 2.5 years. Okay, so therefore I'll have accumulated depreciation 1 April 2011. So it's simply going to be annual depreciation 35 multiplied by number of years. So I'll put it over here, annual depreciation times 2.5. Okay, so that gives you what we are. So that will give you accumulated depreciation. So what I'm going to do, I'm going to say equal, shucks, then just say equal negative 87,500. Okay, so there we have. So here we have it. Okay, so that's my carrying amount at 1 April 2011. So let's continue. So I went from here and I dealt with all of that over there. The land was revalued. So therefore, so this was what I was talking about. At 31 March 2011, the land was determined to be 2.4. So therefore, I don't use the 2.3 because I must use the revalued amount. The latest revalued amount is 2.4 million. Okay, so now let's say on 1 February, the directors of the company decided to sell the Johannesburg property and to relocate the manufacturing operations to Port Elizabeth. Okay, a binding sales agreement was concluded on 1 Feb 2012, and the Johannesburg property was sold for 5.8. So that is a disposal. Okay, so when we dispose of an asset, we dispose of it at carrying amount. So when we dispose of an asset, we dispose of it at carrying amount. So when we dispose of an asset, we dispose of it at carrying amount. Okay, so let's deal with it over here. So working 2. Okay, so we want the carrying amount F31 at 1 February. Okay, so dispose of asset at carrying amount. Okay, so it is costs, accumulated depreciation. Okay, I'm just taking the long route, 1 April 2011, and then depreciation current year. Okay, so we all know the cost is, others is 5.7. This one extra note. Accumulated depreciation is the 87, and then depreciation current year is okay, working 1, and that there is given. Okay, so therefore carrying amount at 31 March, at 1 Feb. So carrying amount 1 Feb 2012 will be the sum of this. Okay, so when we dispose of an asset, we dispose of it at carrying amount. Okay, so where is this now? Disposal going to be equal negative. Okay, for the land, it's easy. Carrying amount will equal to the cost price or revalued amount. So that's going to be equal to 2.4. Okay, so there's no, that's very easy. Okay, so this year is going to be working 2. This year is going to be working 1. Okay. Okay, so that is basically it for this one. Okay, when you have more than one asset for the same class, a class is land, a class is buildings, a class is machinery. Now under land, we have two lands, one from Joburg, one from Port Elizabeth. For buildings, we have 2 buildings, one from Port Elizabeth, one from Joburg. Okay, so for depreciation, I'll do it like this. So because for buildings we have 2, I'll put here Joburg and Pretoria. And Port Elizabeth, and that will be total. Okay, so this is going to be depreciation current year. Okay. So for Joburg, the depreciation for the current year is that. Okay, the total going to be that, and I'm going to say they can find it in working 1. So I'm doing that. I'm going to go over here, and I'm going to tell them for depreciation, they can look to working 3. There'll be nothing for land, but for buildings, it's going to be made up of working 3, which is Joburg and PE. So it will be that number. Okay, so for now, it is only reading Johannesburg. So if I add up this carrying amount at the beginning of the period, and that, it should give me naught, because at 1 February 2012, Johannesburg was disposed of. So there should be nothing left of Johannesburg. Same when it comes to the land of Johannesburg, there should be nothing, because at 1 February 2012, there was absolutely nothing. So I'm happy, even if my numbers are not 100% correct, at least I know things came to be 0. Okay, so that is Johannesburg. So Johannesburg is done. I've accounted for costs and accumulated depreciation. I've accounted for, I know there was no additions. I've accounted for the disposal, and I've accounted for depreciation during the current year. Okay, so I'm happy with that. Now I'm going to deal with the PE property. Okay, so they say, as a result of the decision to relocate operations to PE, Ngu-X Ltd acquired a manufacturing property in Port Elizabeth on 1 February 2012 for 9 million. Land 2 million, building 7 million. So I know I acquired it during the current financial year. So therefore, during the current financial year, I've acquired, so that would be additions. So land is 2 million and buildings is 7 million. Okay, so there I'm happy with that. Then let's say the property was available for use as intended by management and brought into use on the acquisition date. So that means from 1 February, I can start depreciating because the asset was ready for use on that date or available for use on that date. On acquisition date, the residual value of the building was estimated to be 4.5 million, and the estimated useful life of the building was determined to be 25 years. Both the residual value and useful life has remained unchanged. There was no revaluation. Okay, so now I can go work out depreciation. Okay, so I can go work out depreciation. I'm going to use the same format over here. I'm going to use the same format, not copy. And I'll take it to working for. Okay, so working for, and I'll get Control V. Okay, so I know the cost price for PE is 7 million. I know the residual value is 4.5 million. Okay, and I know the useful life is 25 years. Okay, so therefore annual depreciation is 100,000. But I bought the item was ready for use on 1 February. So it was available or ready for use on 1 February. So I can only start depreciating from February. So February, March, only 2 months in the financial year. So therefore it is 16,67. So over here, I will say working for, and then I'll say equal 16,67. Okay, so my depreciation would be 45,833. So there we go, 45,833 and additions. Okay, no revaluation for buildings. There's no indication of any impairment. Because there's no indication of impairment, there'll be no impairment test. If there's no impairment test, there can't be an impairment. Okay, so there we go. So my cost price can only be the cost price of the one building of PE, which is 7 million. And the accumulated depreciation can only be the accumulated depreciation of this one building, which will be basically be that amount over there. Okay, can only be so it will be at 16,67. So that will be working for. Okay, so it can only be the depreciation of the current year for Port Elizabeth. When it comes to the carrying amount for the cost, for land, can only be the one land building, which will be the 2 million. There was no revaluation during the current year for this new building. There's no accumulated depreciation, so therefore accumulated depreciation will be 0. So the carrying amount would equal to the cost price of land, and over here the carrying amount is equaling the cost price minus accumulated depreciation for the PE property. Okay, there's no revaluation during the current year, no impairment loss, no transfer. Okay, so that is basically this over here. We took into account the additions, there was no disposal, and we took into account depreciation, there was no revaluation. Okay, so that's it. Now we can move on to the DVD recording machine. Okay, so they say the directors decided to sell the company's existing DVD recording machine because the reallocation costs to move the existing machinery to Port Elizabeth were too expensive. All the requirements for the classification of the asset as held for sale were met on 30th November 2011. So on 30th November 2011, the conditions or the criteria for a non-current asset held for sale was met. So that means at 30th November, this machine can no longer be classified as PPE. It needs to stop being classified as PPE, taken out of PPE and transferred to non-current assets held for sale. So that means at 30th November 2011, that will be the last date that we can depreciate this asset until. Okay, so we can't depreciate the machinery after 30th November 2011. Okay, that's very important to take note. Okay, so there you can see a binding sale agreement, and the thing will only be sold after financial year end. It will be sold on 10 April 2012, which is after the year end of 31 March 2012. The recording machine was originally acquired on 1 March 2009 for 1.8 million and was available for use as intended by management, as well as brought into use on acquisition date. On acquisition date, the useful life was determined to be 700 units and the residual value 300,000 Rand. Okay, so let's go and see. So over here, we know that the cost price is 1.8 million. Okay, now we need to work out accumulated depreciation. Up until this date, we can't work out accumulated depreciation, but here they tell us from acquisition date until 31 March 2011, the machine produced 65,000 units. Okay, so that's what we can do. So what we can do over here, we can work out accumulated depreciation. Okay, so what working is that? Working 4, so for working 5, we can do the same thing. Okay, so for working 5, we can do the same thing. I'm going to use this format over here. Control C, Control V. Okay, so cost price 1.8 million. Okay, 1.8, 1, 2, 3. Okay, the residual value 300,000. It was given to us. Okay, 300,000. Okay, was given to us. Okay, so the useful life is units. Okay, so this is 700,000 units. Okay, so what it is saying, so this here is depreciation per unit. Okay, so depreciation per unit. Okay, okay, so just take note of that. So now we're going to say number of units used in current year. Okay, so you have a look, units used in the current year. During the current year, the financial year, until 30th November, the machine had produced 80,000 units. Okay, so this will be 80, 1, 2, 3. So this answer will be 214 times the number of units, 80,000. Okay, then we can say number of units used up to 31 March 2011. Okay, and they told us it was 65,000. If I take you back, there you can see 65,000 units until 31 March 2011. So therefore, accumulated depreciation, okay, 31 March 2011 would simply be number of unit depreciation per unit times number of units. Okay, so there we go. Okay, so that's basically what we're looking for. So this here is working 5. Okay, so if I go and have a look, I will, so accumulated depreciation equal negative. So accumulated depreciation will be that. And then depreciation equal negative is that. Okay, so there we go. Now, I just want to put in here the workings, just in case I got it wrong. So working 5, and over there, it is working 5. There were no additions. We can't call it a disposal because it was not disposed. It is only transferred from PP to non-current assets. Okay, we got depreciation. Okay, there's no revaluation. We must have a look if there's an impairment loss. When you have a non-current asset held for sale, that is an indication of impairment. So this is basically what we're going to do. The non-current asset held for sale, so working 6. So a non-current asset held for sale is measured at the lower of carrying amount and fair value less cost to sell, okay, less selling costs, okay, so cost to sell, okay, so just take note. So non-current assets measured at the lower of carrying amount and fair value less cost to sell. So basically we will do a test, okay, so we have a carrying amount. So what do we know? It is costs, okay, accumulated depreciation and depreciation current year, okay. Okay, so costs, we know it is 1.8, 1, 2, 3. Depreciation, accumulated depreciation, and then, okay, so this year is working 5. Okay, so carrying amount at the date of, at the date when non-current asset held for sale criteria are met. So this is carrying amount 30 November 2011. Okay, now we must compare to fair value less cost to sell, which they told us was 1.5 million. Okay, where was that now? So somewhere, here we go. The machine's fair value less cost to sell was determined to be 1.5 and remained unchanged on 31 March 2012. So fair value less cost to sell on 30th November 2011 was 1.5. Okay, so remember, what do we want? It must be recognized at the lower of carrying amount and fair value less cost to sell. So which one is lower? It is the carrying amount. So if fair value less cost to sell was lower, then there would have been an impairment loss. But because fair value less cost to sell is more than carrying amount, there is no impairment loss. Okay, so therefore over here, I will put in here, so that is 0. So working 6 and working 6. So working 6 will show me impairment is 0. Okay, maybe I'm going to just do that. Equal. And working 6 will also show me what I must transfer. Okay, 148. I must transfer that. So if we have a look, if I add up all of this, it must come to 0. Why must it come to 0? There's only one machine, and the machine has been transferred from PPE to non-current assets held for sale. Okay, so just take note of that. So therefore, I know even if the numbers are not 100% correct, I know I'm on the right track because it is 0. Okay, then you can add up all of this if you want to. Okay, so that's basically it. And that's the answer for all of this. Okay, so there we go. So that is what we basically wanted. And that is basically the answer. So just take note, a good way to work through it is to simply go asset by asset and fill in the complete thing. Okay, so that was 1.1. Okay, now we can do 1.2. So 1.2, you can read up on all the wording, but basically you will just have, so this will be non-current assets, sale, okay, and you simply have machinery, and it will be equal to it will simply equal to that. Okay. And then you can see there's some wording that you can add, like you can say the criteria for non-current sales for non-current asset held for sale were met at 30th November 2011. The expected date of sale is 10 April 2012 for a cash sale of whatever amount, if we have an amount. Okay, and that's basically what we will have. Okay, so that is 1 point. That's question 1. The notes. Okay, so let's just quickly have a look. So question 1, so this is question 1. Prepare only the notes to the financial statement, PPE, and non-current assets held for sale, 26.5 marks. Okay, next, what do they want us to do? Next, they want us to calculate the deferred tax balance in the statement of financial position of, okay, using the statement of financial position approach. So so take a note there, they said prepare. That is why we set it up as such, okay, saying the statement name and the company name, statement name, and date, and then we have the notes. Okay, so the next one is not that, we're just simply going to do a calculation. Okay, so how I set up my calculation, I set it up, you can do it your way, but I basically set up like this. Assets, I have, and then liabilities. Okay, so my assets are positive, my liabilities are negative, and that is why I put liabilities in brackets. I make it clear to them that this is at 31 March 2012. You need to state the date. Okay, so 31 March 2012. So assets or liabilities. Okay, then I have carrying amount, tax base. Then I always do this inclusion rate. So in a deferred tax calculation, they don't usually have a column for inclusion. But if you think about it in the real world, you want to use Excel, you want to hard code things. So then you'll put in a column for the inclusion rate, either 100% or 80%. Then I'll have my temporary difference, and then I'll have deferred tax at 28%. So remember, this question said 28%. A new question will most likely have 27%. Okay, so just be aware of that. Okay, so now we will just list. So remember, we only want the deferred tax at 31 March 2012. We want the balance. So what's important to take note over here, they ask us to calculate the deferred tax balance. So we just need to do one calculation. If they asked us to calculate the deferred tax movement, we'd have to have a calculation for the end of last year, which is 31 March 2011, as well as 31 March 2012, the current year. Then the movement would be current year minus prior year. But in this case, they don't want the movement, they just want the balance. So we're only going to do the calculation at 31 March 2012. So what's important to take note, you need to identify all the assets and liabilities from an accounting perspective, and you need to identify all the assets and liabilities from a tax perspective that draws tax consequences, and that must be in your list of assets and liabilities. So that's basically what we want. To say show all calculations around calculations to the nearest rand. Okay, so all I'm going to do, I'm going to go through this list. Okay, so we have, so if I look at Johannesburg, I won't include Johannesburg because Johannesburg, there's no property at 31 March 2012. If I had to work out the movement, then that means I would have to have a deferred tax calculation at 31 March 2011 and 31 March 2012. Then I would have Johannesburg. But because I only won the balance at 31 March 2012, I only do the deferred tax calculation at 31 March 2012. So for that, I asked myself, is there a property at 31 March 2012 for Johannesburg from an accounting perspective and from a tax perspective? From an accounting perspective, we dispose of it, is no longer there. From a tax perspective, we also dispose of it, so it's no longer there. So I won't have that. Okay, when it comes to the property on Port Elizabeth, the property on Port Elizabeth is there as at 31 March 2012. So now I know I will have that. So now I know I will have that in my books. So the asset is land and buildings. Okay, so the carrying amount at 31 March 2012 is that. At 31 March 2012 is that. Okay, so I'm just going to say from Q1. Okay, so at 31 March 2011. So the tax base for land is also 2 million. That is the cost price. If there was any difference, there would have been an inclusion rate of 80%. Okay, now I must work out the tax base of buildings. Okay, so now I must work out the tax base of buildings. So remember they told us the tax base of buildings is 5% per annum and not apportioned for a period. Okay, not apportioned for part of the year. So I will just do over here and I'll have my workings. Okay. Okay, so for working one, I'll just basically have cost, which is from a SARS perspective, it is 5.7 million. 7 million. Okay, from a SARS perspective, it is 7 million Rand. Okay, not 77. Okay, so 7 million. Then we will have section 13.1 allowance, which is basically 7 million multiplied by 5%. So we bought it in the current financial year. So we only had depreciation for one period. Okay, we only had an allowance for one period. We bought it during the year, but there's no apportionment. Okay, so we don't apportion for part of the year. So it will simply be 7 million, 123 times 5%. Okay, so therefore, tax value, i.e. tax base, is going to be cost minus all allowances to date. There was only 1 year of allowances, so that will be it. So it will say equal 6650. Okay, the inclusion rate for buildings is 100%. This is a revenue asset, not a capital asset. So my temporary difference is carrying amount minus tax base multiplied by my inclusion rate. Okay, so there we go. Okay, just so you know what I do over here. If my answer is negative, it is an asset. If it's positive, it is a liability. Okay, so that is just basically how I think about it. So do this. Okay, do this quickly. Okay, so this will just simply be temporary difference times 28%. Okay, that will be 0. That will be whatever. Okay, so it's a positive, so it is a liability. Okay, now I'll go to the next one. Okay, so now I will go to the next one. So I did, so what did I do? I did Johannesburg, there was nothing. At 31 March 2012, I did Port Elizabeth. There is something at 31 March 2012. The last asset that I have is a recording machine. Okay, so I'm going to have here machine, okay, or machinery. So if I have a look, there's nothing for machinery. So the carrying amount equals 0. Okay, but remember, from an accounting perspective, we have a non-current asset held for sale. Okay, so my non-current asset held for sale is 1489, whatever it is. Okay, from a tax point of view, tax does not have a concept known as non-current assets held for sale. So from SARS's perspective, that will be 0. Inclusion rate still 100%. Inclusion rate still 100%. Okay, the tax base from a SARS point of view, we never legally disposed of the asset. So from a tax perspective, we still have the asset. So from a tax perspective, we still have the asset, and as a result, we will still, so therefore, there is a tax base for it. Okay, so in SARS's books, there would be a machine, so therefore they would have a tax value for it. Okay, so I'm going to have working 2. So this here is working 1. This here will be working 2. So from SARS perspective, the machine cost is 1.8123. Okay, from SARS perspective, so now I must work out the allowance. Okay, so section 11E. Okay, I'm going to put the date, which is 1 March 09 to 31 March 09. Okay, I'm going to work in periods reported on 1 March. So I'm going to work in financial periods. Okay, then we go again. Section 11E. 1 April 09 to 31 March 2011. Okay, then we're going to go again. Section 11E. So now remember, at 30th November, we have disposed of this asset. I mean, we have classified it to a non-current asset held for sale. Now, it's a bit tricky now. I'm not 100% certain, but we'll go with using it for the full year. So I can't remember with certainty now whether with section 11E, if a requirement is actually used in production. So technically it's not used in production, it's standing ready for sale. Okay, so if that is the case, then it should be 8 months. But if that is not the case from a section 11E point of view, then you can use the full 12 months. For now, I'm going to use the full 12 months. Okay, so 1 April 2011 to 31 March 2012. Okay, so this year is 1 month. Okay, this year is 2 years, and this year is 1 year. Okay, so the calculation, 1.8123 divided by 6 years, multiplied by 1 divided by 12. This one over here, 1.8123 divided by 6 multiplied by 2 years. Then this one over here, 1.8123 divided by 6. Okay, and for the full year. So if I work it out, I'm going to say equal negative 1,800, 123 divided by 6 multiplied by 1 divided by 12. Okay. Okay, then this one over here, it is equal to 1.8123 divided by 6 times 2. Okay, and this is going to be, make that negative. So then equal negative 1.8123 divided by 6. Okay, so like I said, I'm using a full year over here, but I mean, you could argue that, I can't remember what the section 11 is saying, whether you must be using it in the production of in the production of income. If that is the case, then technically you can only depreciate for 8 months out of the 12 months, but let's just assume you can do it for the full year. Okay, so therefore tax value or tax base would be sum equal sum, there we go, equal sum, yeah, there we go, 875. So I'm going to say tax base 875. So if I use this formula over here, that will be the temporary difference, and if I use that, that would be, so it will be an asset, that would be a liability. So that is all the assets and all the liabilities that draw tax consequences from a tax point of view as well as from an accounting point of view. Okay, so I just want to add up those. Okay, so it's a positive, so that's a liability. This is deferred tax balance. Okay, so that would be the answer. So the answer is deferred tax liability of at 31 March 2012 of 265,333. Okay, so that's basically the answer. So that is your 14.5 marks. So very important. Always identify all the assets, all the liabilities from a tax point of view as well as from an accounting point of view at that date. But only the assets and only the liabilities that draw a tax consequence. You don't have to have other assets and liabilities that does not have a tax consequence. Okay, so like technically, you did not have to include that, but I wanted to include it for completeness purposes. Okay, so that is question 1 and question 2 of this question. So this is question 1, fact 3761, that letter 108, 2022. Okay, in the next video, I'll do one more video covering some other topics. Okay, so that is a 40 marker. So I hope you find it beneficial. Thank you. Bye-bye.